Hey guys, thanks for joining. Well, my parts 1 and 2 of the series were so popular that I'm putting out this bonus video. I'm titling it, What's the Rush? Because I want to focus on why you should have a sense of urgency to join the Bitcoin revolution and the digital gold rush sooner than later. Not wait another week, not wait another day. There's been a lot of wild price predictions that you've seen out there, but those are very rooted in a basis for that belief, and we'll review a lot of those today. So hopefully by the end of the video, you'll have a strong sense that this Bitcoin price explosion actually might happen sooner than later. So remember, I'm not a finance professional, and this is not investment advice, but consider it your invitation to join the Bitcoin revolution. So if you haven't already, hit that like button and let's get into it. All right. So the first thing we want to talk about is something that happened at the very beginning of this year, which was that the spot Bitcoin ETFs launched. And this was something that had been anticipated for many years. Many asset managers applied and were rejected by the SEC, but ultimately it was approved and it launched. And when it launched, it was actually the most successful ETF launch in history. You can see that within a single day, they had 4 billion of inflows, but more importantly, over the 30 years of 5,000 ETFs launching, no other ETF has compared to what the Bitcoin ETFs did. And there are actually estimates that there will be about $150 billion in inflows over the next few years, $150 billion. To give you an idea about what that, so far we have 65 billion that have been inflowed, which is about 4.6% of the total Bitcoin supply. But again, those aren't held by the asset managers. Remember, those are being held by the retail investors and the institutional investors who hold those ETFs. But it does represent a significant share of the Bitcoin supply. And to put it in perspective, what the Bitcoin ETFs have done, this is a chart showing the top ETFs by assets under management as of September 30th. You can see the number one, the Spider S&P 500 fund, has $590 billion, so almost $600 billion. The gold ETFs, there's 3 main ones that are combined, have $115 billion of assets under management. And then lastly, you can see Bitcoin down here, 59 billion assets under management as of around end of September. But that will put Bitcoin at rank number 33. But you can see it's a little over half of what gold's assets under management are, and it's about 1/10 of the top fund. So 590 billion versus 59 billion. Now this is pretty significant because gold, remember, had a head start of an ETF 20 years ago. So Bitcoin is 20 years behind, but it's already more than half of the gold assets under management. So very significant. The other thing that's really exciting is that the spot Bitcoin ETFs have been snapping up Bitcoin like crazy. So since January when it launched, this is a chart each week of how much Bitcoin is being bought by the ETFs versus how much Bitcoin is being mined. So that's the red line. And you can see that consistently Bitcoin is averaging much more purchases. The ETFs are buying. And on average, it's bought almost 3 times the amount of Bitcoin that has been mined. 342,000 have been bought by the ETFs versus 120K mined. So this is huge. It's going to really creating a supply constraint. The amount of demand is outstripping the supply that's available from the miners, from the new Bitcoin that's created, as well as on exchanges. And so you know what happens when you have lots and lots of demand, but diminishing supply. That's one reason why we're super excited about what's going to happen with the Bitcoin price. And these ETFs are just getting started. The institutional adoption, recommendations by asset managers to their institutional clients, the family offices, state pension funds, any of these large institutions as well as retail investors are really just now getting into it. They're just getting started, and it's going to really take off in 2025. Let's hear really quickly from Larry Fink about what he thinks about these ETFs. He is the CEO of BlackRock. BlackRock holds the largest ETF. It's IBIT, which is the largest Bitcoin ETF, and he shared some thoughts a few months after the launch.
I was a proud skeptic. And I studied it, learned about it, and I came away saying, okay, My opinion 5 years ago was wrong. Here's my opinion today. This is what I believe in today. I believe the opportunity today. I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency, debasing their currency by excess deficits, and some countries are.
So you heard Larry say how he was a proud skeptic, but he studied it, and he realized that he was wrong all these years about Bitcoin. Of course, being the head of the largest spot Bitcoin ETF will give you a lot of reason to change your mind as well. So that's Larry Fink, that's the ETFs. But let's turn our attention to something else that's happening this year, which is the wider federal and U.S. government monetary and fiscal policy. So what we're seeing right now, this is a chart of the federal funds effective rate. This is the rate that banks use to lend to each other. And as you know, it had been a little high, was 2.4% before the pandemic, but then during the pandemic with the federal emergency response to try to jumpstart the economy or keep it running, they lowered rates down to near zero. That persisted for a couple years until around February 2022 when the Fed decided, hey, maybe we should do something about this skyrocketing inflation that everyone's complaining about, consumer prices. So they actually ushered in an aggressive quantitative tightening period where there were, over the course of 16 months here, they made 11 rate cuts that brought the rate up to about 5.5%, 5.5%. And that has been the case now for a little over a year. They kept rates steady, and then just this last month on September 18th, they lowered rates for the very first time in several years. Let's see, it's been 2.5 years since they had started raising rates, but they lowered it by 50 basis points, by 0.5%. So that's where we stand now, and that is basically the start of a quantitative easing period where money will become easier to get. Loans are going to be easier to take out with lower interest rates. And one thing that can be important to think about is this period of quantitative easing could last for a period of time. I created this chart showing the Fed's rate cut history, and this shows how long it takes from the first cut until they start to raise rates again. You can see I mentioned in September they lowered rates for the first time, but going back 25 years, on January 2001, they lowered rates, and it took 3.5 years until June of 2004 before they started raising them. Similarly, in 2007, they cut in September. It was 8.5 years, 8.25 years before they started raising rates again. On average, over the past 25 years, once they cut, it's about between 4 to 5 years before they raise. So right now, September 18th likely started a 4-year period of decreasing or steady rates. Translation, money will be easier to get. Money supply will start increasing because when more debt is taken, that's how money is printed, as we learned in part 1. And you can see here, as this chart of the M2 money supply, the Federal Reserve and banks have actually already been inflating the M2 supply since October of last year. They weren't waiting for rates to be cut. They actually have many other means for creating money, printing money, and increasing the supply. And it's already been happening since last October. So the money printer is starting to fire up, and we're about to see the money printer really go burr. Lynn Alden put out a post, an X post last month on September 24th, where she drew attention to the alignment of different assets like Bitcoin, stocks, gold, and bonds to global M2, so the inflation of global money supply. And what she saw is that Bitcoin is actually the most aligned with global money supply. It has an 83.2% correlation than any other asset. So this period that we're seeing now, even though increasing M2 money supply is bad in terms of inflation and devaluing the dollar, debasing the currency, it actually has positive effects on Bitcoin price especially. All right, so we're seeing that period, which is something to be excited about if you hold gold. I mentioned the first Fed rate cut happened on September 18th. Something else happened coincidentally, not coincidentally, on September 18th, which was BlackRock released a white paper which drew lots of attention in the Bitcoin world because they took a very strong bullish stance on Bitcoin. You know, their ETF had been successful for 9 months by now, but they now have a very strong basis for being bullish. And the main point of their white paper was that Bitcoin is a unique diversifier that should be considered and added to your portfolio. In fact, its adoption happens most when there's concern, growing concern globally over monetary stability, geopolitical stability, U.S. fiscal sustainability, political instability. These type of events that would cause downturns in other assets actually help Bitcoin in many cases. And in fact, they back that up with this chart showing how Bitcoin stocks and gold respond to various geopolitical events. In this case, you see the US-Iran escalation in 2020, COVID outbreak in 2020, a few different events. And this is showing how stocks and gold responded within 10 days after the event or 60 days. Looking at the short term 10 days, you see that half the time Bitcoin outperformed the stocks and gold, and half the time they did a little bit worse. But then if you go 60 days after the event, in every event, Bitcoin outperformed both stocks and gold in terms of recovering from that initial geopolitical event. So this is kind of bearing out the Bitcoin case as gold 2.0, as a safe haven, as some asset that people look to in times of geopolitical instability and uncertainty. All right. Now, in my earlier parts 1 and part 2, I didn't really get to talk about the Bitcoin inflation schedule. The halving is what it's known as in the Bitcoin world. But this chart shows the inflation of Bitcoin supply. So what happened in 2009, as we learned, Satoshi Nakamoto launched the Bitcoin blockchain, but there were 0 Bitcoin. But then every block that was created mined 50 Bitcoin at that time. And so initially the inflation was very high because it started from 0, but then roughly every 4 years there's a halving event, and that is the rate of new Bitcoin being mined gets cut in half. So every block after the first halving, every block only generated 25 Bitcoin. And then with each successive halving, you see that the amount of Bitcoin created per block is cut in half. To where we are today in 2024, we're producing 3.125 Bitcoin per block. So the bottom line is that we have the lowest inflation rate ever. We have mined 19.7 million out of the total 21 million Bitcoin that will ever be created. But that's going to take another 100 years for that to happen. But the significant thing about this is that for the first time ever, Bitcoin's inflation rate is less than gold. So the amount of new Bitcoin created per day versus the total Bitcoin supply, well, annually at least, is 0.84% versus gold's average inflation for the past few decades has been 1.5%. The new gold mined versus the gold supply. So Bitcoin actually that's why we call it the scarcest asset, the hardest asset. It's the hardest to create, to mine, to obtain. And contrast that with the US dollar, which can be created out of thin air for no cost by the Federal Reserve and by banks. So Bitcoin is the hardest, scarcest asset due to the decreasing inflation rate. And this is a chart, going back 11 years or going back to 2012. This is the price of Bitcoin performance by year. Okay, the Bitcoin performance. So each one of these candles is 1 year. And on the y-axis, this is not a linear 1, 2, 3, 4, but this is actually what's called a logarithmic. So each level is 10x. So 10x to the next level is 100, 10x to the next level is 1,000. Bitcoin tends to grow so quickly that we actually have to measure its performance in terms of how quickly it 10x's from the prior level. And from this chart, you can see that Bitcoin left the $100 level in 2013. It lingered in that level for about 4 years. Then in 2017, it had 10x'd and stayed in that level for about 4 years. Then in 2020, it reached the 10,000 level and stayed there for about 4 years now. It's on and counting. But this is one reason why we expect that any day, any week, Bitcoin will broach the 100,000 level and likely stay there for a number of years. Bitwise Investments put out this chart showing the 4-year cycles of Bitcoin. We talked about this last video, where there's 3 winning years followed by 1 down year, 3 up years by 1 down year. And this has happened now. We're in the 4th cycle of that. But this chart shows, I've highlighted the halving years, and you can see the performance in halving years ranges from 123% up to 300% in the past few halving years. So far this year, we're up 60% year to date. So that's one reason why we are bullish. We still have a couple months left ahead of us. Q4 tends to be the most explosive quarter of the year. And then also the year after the halving, which is next year, has done very well historically, and which is why we're bullish for the Bitcoin price, not just for the remainder of this year, but also into next year. Zooming into just this current quarter, comparing the last 2 halving year Q4s, you see that in 2016, just from the Q4 alone, Bitcoin rose 62%. In 2020, it rose 210%. So far in this Q4 of 2024, we're up only 7%. So this is one reason why we are expecting, November, December are very strong months. October tends to be strong in the last part of it, especially once we get the uncertainty of the election behind us. The price will tend to be more free to go up when you eliminate that uncertainty. But zooming in to just this quarter, this is one basis for people to be bullish about Bitcoin in the near term. Translation: better to get in earlier than later if you're on the fence. Rect Capital posted this to X just in September, so again last month. But this is showing you the last 2 halvings in 2016 and 20 and this year's. But then what happens with the Bitcoin price? So what he's highlighting is 547 days prior to the halving in 2016, Bitcoin had reached a bottom price point. Then it was 518 days after the halving, it hit a peak. Similar in 2020, again, 517 days before the halving, it bottomed. And then 549 days after the halving, it peaked. So it's kind of a mirror with similar time ranges before and after the Bitcoin halving. Again, in 2024, this past April, we saw 500 days prior, 517, it had bottomed. And now, if you project out 548 days after the halving, that would bring us to October 2025. This is the one reason why people have projections that Bitcoin will continue to go up into next year, into Q4 of next year, based on past patterns. So now let's hear from Chamath Palihapitiya, zooming in on around the halvings and why we have a basis for confidence in the price.
You should really look at the pattern of Bitcoin after a halving. And I asked him to go back and look at the price performance 1 month after a halving, 3 months, 6 months, 9 months, 12 months, and 18 months after a halving. But then within 6 months to a year and 18 months of these things, there are these crazy price appreciation cycles that happen. So that's what this page shows, which is, 18 months after the first halving, the Bitcoin price returned 45x. After the second halving, it returned almost 28x. And after this third halving, it returned almost an 8x, which is really incredible returns in such a short period of time. If you go to the next page. And so if you graph that, this is what it starts to show, which is what is this price performance after each of these halving cycles. And so if you apply the averages, and again, these are just averages, they're by no means predictions. Okay, so I just want to qualify that.
Yeah,
these are
this is not financial advice.
It's not financial advice. These are just guesses. Data. We took these and we applied it to the price of Bitcoin. And if you go to the next page, you start to see what could happen if you just take the average of the last few cycles. So because the first cycle was so extreme.
So you see how Chamath is looking at the pattern and behavior of the last 2 halvings and what we could potentially expect for the upcoming price movement. If we look just at the last halving in cycle 3, we would expect a Bitcoin price of around 500,000 by October 2025. If we actually looked at the average of cycles 2 and 3, the halvings in 2016 and 2020, we could think of a Bitcoin price over $1 million by 2025. So it's really just a range. They're just, as he said, he was not making a prediction. It's more just showing projections based on past performance. So now let's look at a few of the other experts and industry followers, technical analysts. I made this chart showing the predictions from not just Chamath, but others. And you can see that for end of year, Plan B is projecting a 150K target. In 2025, next year, there's a number of analysts are looking at 200 to 500 range. And then 5 years out and even 20 years out, there's actually even loftier projections in the millions. You saw from part 2 that I posted the justification for Bitcoin price to even go into the millions of dollars based on increasing share of global assets because there are $900 trillion of global assets, and Bitcoin is really just at 1 trillion of that right now. All right. So lastly, I just wanted to show this Bitcoin price going back from the past 11 years. And this is again on a logarithmic scale, but you can see the trend, and just following the trend, here we are today. And then if you can just draw a straight line up, just extending that, you could see a justification for a Bitcoin price in September 2029 around 750K. So that's what I wanted to show you today. Hopefully you have a sense for what's happening at the wider scale, at the 4-year halving cycles, with the ETFs at launch, with the money printer starting to fire up, and why this digital gold rush could really take off for sure in 2025, but even for the remainder of 2024, and why you want to get into it sooner than later. Check the show notes if you are interested in seeing how to buy. There's a playlist there with guides on how to buy Bitcoin, or drop a comment or hit me up with the contact information in the show notes, and I'm happy to help you. So thanks for joining again, and hope to catch you next time. But meanwhile, be wise, be safe, and stack stat.